5.8% rise in the price of gold on the week. Silver up 7.2% on the week, closing the week back above 70 at 72. That dwarfed the gain in the stock market. The Dow was only up about 1.65%, S&P up about 2.4%, and the Nasdaq up about 3.2%. But all these indexes still down on the year, whereas gold is still having a good year. The trade deficits are as bad now as they were back then. The U.S. economy has been very weak over the past year. The stock market gains have been minimal. I think since Liberation Day, maybe the S&P is up, I don't know what it is, 15% or something like that. I forget exactly, but gold's up about 50%. This was one of the most obviously unconstitutional taxes. So how did they not know this from day one? But we have a problem in the financial markets. We're going to have a problem in housing. We have a problem in stocks. All of this is because interest rates have been too low for too long. Buffett talked about how much damage that does. If prices are going up 2% every year, compounded, robbing people of their purchasing power. I mentioned that I thought the price of gold had likely bottomed. We got down to around 4,100 on Monday morning of that week before we reversed. And then we rose up, I think yesterday, we got as high as almost 4,800. So that's about a 17% rise. Gold ended up closing on the week at 46.76 because we did pull back yesterday in response to the president's disappointing speech, which I will get into next. But we still had a 5.8% rise in the price of gold on the week. So anybody who followed my advice last weekend and went to Schiff Gold and bought some gold and silver had a pretty good week. Silver up 7.2% on the week, closing the week back above 70 at $72.90. But an even better performance out of the gold and silver mining stocks. This is despite yesterday's drop and the fact that the week was only 3 trading days long, other than yesterday's drop. But so in the 4 days of the week, the GDX was up 14.5%. And the GDXJ up 14.8%. That's after yesterday's decline. So the first 3 days of the week saw huge gains, mostly in Tuesday and Wednesday. Most of the gain were those 2 days back to back.
Gold may be signaling more than just a rebound, not a temporary spike. As Peter Schiff points out here, gold climbed nearly 17% from Monday's low to a $4,800 peak, and even with a pullback, closed up 5.8% on the week, dwarfing most market returns. Silver and mining stocks surged even further, with GDX and GDXJ up over 14% despite a short trading week. These gains highlight real capital rotation into tangible assets as hedge against political uncertainty. Next, Peter Schiff discusses how these moves reveal the fragility of paper-driven market assumptions.
That dwarfed the gain in the stock market. The Dow was only up about 1.65% on the week. S&P up about 2.4%, and the Nasdaq up about 3.2%. But all these indexes still down on the year, whereas gold is still having a good year, despite having its worst March since 1980. Within that, it's still having a great year. But I think gold potentially could have the best April. Not 1980. Gold had its worst month since 2008. In March. But I think gold could have its best month since 1980. That's when gold had some huge gains. And of course, that was the year that gold peaked out at 850. But we had some huge monthly gains. But I think the stage has been set for a huge monthly gain this April, given the magnitude of the drop that should not have taken place in the month of March. By the way, Russell 2000 also had a pop on the week, about 2%. But again, all these gains are dwarfed by the gain in gold and silver. Now, yields on U.S. Treasuries did fall slightly on the week, but not much. The yield on a 10-year Treasury closed at about 4.31 something, and on a 30-year, 4.89. So, the highest the yields really got was about 4.4 on the 10-year, and 4.99. I don't think I ever saw us touch 5%. So we're not far from the absolute highs on yields. Dollar index also had a positive week, but just barely. I think it eked out about a 25 basis point gain to end the week just north of 100.
Headlines make gold's volatility look extreme, but it masks underlying structural opportunity. As Peter Schiff points out here, while stock indexes rose just 1.6 to 3.2%, gold is setting up for its best April since 1980, with yields still near historic highs. Treasury yields and the barely rising dollar index reveal capital-seeking safety, not risk-on enthusiasm. Russell 2000's meager 2% gain shows liquidity remains skewed toward tangible assets. Next, Peter Schiff unravels why these patterns may foreshadow broader market stress that conventional analysts ignore.
The trade deficits are as bad now as they were back then. The U.S. economy has been very weak over the past year. The stock market gains have been minimal. I think since Liberation Day, maybe the S&P is up, I don't know what it is, 15% or something like that. I forget exactly, but gold's up about 50%. 50%. Not a lot of people might have anticipated that the market that would react the best to the tariffs would be gold. Because everybody said that the tariffs were going to strengthen the dollar. That didn't happen. The dollar is a little lower than it was on Liberation Day. But gold is substantially higher. And of course, if you recall the podcast that I recorded, my very first one after Liberation Day, what did I say? I said the tariffs were unconstitutional. I said it very clearly. I explained exactly why they were unconstitutional. I said the president has no authority. They're not reciprocal. They're reciprocal in name only. We weren't reciprocating against anything. I said these were across the board revenue-raising tariffs, and the president had no constitutional authority to tax the American public, that Congress needed to do it, that it needed to originate in the House before the Senate had a chance to vote on it.
The narrative that tariffs strengthen the dollar is misleading, and gold investors are proving it. As Peter Schiff points out here, gold surged 50% since Liberation Day, even as the dollar weakened slightly, contradicting conventional expectations. Tariffs were presented as economic leverage, but were unconstitutional and revenue-raising rather than reciprocal, distorting policy impacts. Investors who recognize structural flaws in markets and policy benefited, highlighting how official messaging often conceals risk. Next, Peter Schiff discusses the constitutional oversight's hidden cost to ordinary Americans and market pricing.
And then only after it passed both houses of Congress could the president sign that kind of a tax hike. Well, recently the Supreme Court agreed with me in I think it was a 6-3 decision, and declared those tariffs unconstitutional. Thing is, it took the Supreme Court a year. I knew it was unconstitutional day one. The problem is it took so long. There should be a quicker process to get an unconstitutional law struck down, because we had a whole year where people paid an illegal tax. And now it's going to take many, many years for the people who paid that illegal tax to get their money back. And of course, a lot of businesses may have raised their prices in response to having to pay the illegal tax. The customers who paid those higher prices, they're not going to get their money back. So if there's a refund at all, it's just going to be to the businesses. They're not going to refund it to the consumer. So this is a huge problem. But it should have been obvious. It should have been obvious to Donald Trump. It should have been obvious to his advisors. I mean, how could you not know?
The legal delay amplified financial strain on consumers far beyond headlines. As Peter Schiff points out here, the Supreme Court's 6-3 ruling confirmed tariffs were unconstitutional, but a year-long enforcement window created hidden costs. Businesses passed illegal taxes to consumers, meaning refunds may never reach the public. Wall Street never flags this indirect inflation effect, yet it impacts purchasing power and risk management decisions. Next, Peter Schiff talks about the cascading consequences of policy missteps on everyday markets and investor trust.
This was one of the most obviously unconstitutional taxes. So how did they not know this from day one? Why enact a tax that is clearly unconstitutional when you're going to create such a huge problem with having to refund it? So I don't know, like, if the president didn't get any good advice from any of his advisors, or if he was told it was unconstitutional, but just do it anyway. Who cares? Who cares about the Constitution? Who cares about your oath of office? Just enact it anyway, and we'll roll the dice. I mean, maybe the Supreme Court will have a bad decision. I don't know. But I was very adamant that it was an easy call. It really should have been 6-0. I don't know why any of the justices went the other. Maybe it was 7-2. No, was it 7-2 or 6? I forget now what it was. But there was a dissent, and there should have been no dissent because it's so obvious. I mean, any justice. I mean, I know Clarence Thomas dissented. I lost a lot of respect for him. I thought he was one of the better justices on the Supreme Court. I don't know how he could have got this one wrong. Anyway.
The political calculus behind unconstitutional taxes is rarely scrutinized in mainstream media. As Peter Schiff points out here, the decision should have been unanimous, yet dissenting justices and poor advisory guidance allowed widespread legal risk and financial distortion. Investors rarely see how policy misjudgments like this ripple through pricing, business behavior, and market confidence. A 6-3 Supreme Court decision highlights the systemic failures, not just a legal oversight. Next, Peter Schiff shows why this misalignment between law and enforcement is a warning signal for portfolio security.
Another big development, though, on the week, and this story has been building, and I haven't really touched on it in prior podcasts, but we've had several funds that have shut down to redemptions, meaning that investors who have asked for their money back have been told that you can't get it. And as more and more funds shut down their redemptions, that creates a moral hazard or a self-fulfilling prophecy where more people want to redeem. Because now, if I have money invested in a fund and the redemptions haven't been stopped, but I see other funds are halting redemptions, I may think, you know what, I better redeem my money now while I can before it gets closed. So this is going to be a big problem for the investment management industry, when now you have a lot of people who are worried that if they don't get their money out now, they're never going to get it out. And of course, if a lot of these funds own illiquid assets, or maybe there's liquidity there, but if they go to sell right away, they're going to drive the price down. And if the markets realize that certain funds, which have large positions in certain assets, are getting big redemptions, they may front run the trade. They may start selling those assets themselves. The bids might back away, and you have a real problem. But also what this probably reveals is that a lot of prices may not be the real prices, because if companies are getting redemptions that would require them to sell assets, and now they're closing the door so that people can't redeem, assets that should be being sold are not being sold because they're halting the ability of people to sell. Well, clearly that could be distorting prices. Maybe these prices would be a lot lower. Of course, they would be a lot lower if the owners were allowed to sell, but they've locked the doors. And so that means the information that we have, the pricing mechanism in the markets, is faulty because we're not allowing the redemption. So this is another sign, too, of a major financial problem that is brewing, that could hit, any day.
What appears as orderly fund management may conceal a systemic liquidity crisis. As Peter Schiff points out here, multiple funds halting redemptions creates a self-fulfilling rush, where investors fear being locked out, amplifying selling pressure. Illiquid assets artificially prop up reported prices, masking true market value and undermining price discovery. Front-running by other investors could exacerbate volatility, revealing the fragility of the investment management system. Next, Peter Schiff discusses how these redemption freezes might be the first visible cracks, signaling broader financial instability.
But we have a problem in the financial markets. We're going to have a problem in housing. We have a problem in stocks. All of this is because interest rates have been too low for too long, and they've been propped up based on the expectation that more rate cuts are coming, that we have a Fed put, that we have a Trump put. But now the markets think the war may have preempted that, and that the put is no longer there, and what's been holding up the market doesn't exist. In fact, I was listening to an interview of Warren Buffett, and I think it was on CNBC. He was interviewed, and one of the most interesting comments that Buffett made was that he said he doesn't know why, and he doesn't agree with the Fed's 2% inflation target. That he believes and he wishes that the target was 0, which is true. Why should the Fed target inflation? If the Fed's goal is price stability, then why target a 2% increase every year?
Investors are ignoring the artificial supports masking market fragility. As Peter Schiff points out here, low interest rates, expectations of rate cuts, and the perception of a Fed put have propped up housing and equities, but those crutches may vanish. Market sentiment is shifting as geopolitical tensions and policy uncertainty erode confidence. Warren Buffett's critique of the 2% inflation target underscores the misalignment between nominal targets and real purchasing power. Next, Peter Schiff shows why removing these supports could trigger significant market repricing and risk exposure.
Buffett talked about how much damage that does. If prices are going up 2% every year, compounded, it takes its toll. It is robbing people of their purchasing power. But I'll go a step further. Why target stable prices? What if prices were going to fall? What if prices should go down 2% a year? Why not let them? Why do you have to stop a good thing from happening? It is not a bad thing if the cost of living goes down. Everybody would agree. I mean, you could just do a random poll of people and ask them, next year when you buy gas, would you like it to be cheaper or more expensive? When you go to the grocery store next year, do you want to pay lower prices for food or higher prices? When you get your utility bill, would you like it to go up or down? You know, when you have to renew your kids' college, do you want to pay more next year or do you want to pay less? Do you think there'd be any consumer, any American, who would choose higher prices over lower prices? Nobody would choose that.
Inflation targets disguise the real benefits of falling prices. As Peter Schiff points out here, compounding 2% annual increases erodes purchasing power. Yet policy consistently blocks deflationary benefits. Allowing prices to naturally decline would enhance living standards, giving consumers tangible gains in energy, food, and utilities. The consensus favoring stability masks opportunity and misleads both markets and households. Next, Peter Schiff talks about how embracing price deflation could recalibrate expectations and restore consumer and business confidence in a more transparent market.
But even when it comes to businesses, if you ask the businessman, would you like your costs to go down a year from now so that you can lower your prices to consumers? Or do you want your costs to go up so that you have to charge your customers more money? Every businessman is going to say, I want my costs to go down. I want to be able to lower my prices, because every businessman knows if they can lower prices, they'll sell more stuff and they'll make more money on higher volume. So everybody is better off with lower prices. The producer is better off, the consumer is better off. So why target price stability if prices would otherwise go down? So there is no reason to have any kind of target. Just let the market determine prices and don't try to steal the benefits of falling prices by creating inflation and using the fact that the free market lowered prices or would have lowered prices to deceive the public and steal that gain. Because people have no way of knowing how much lower prices would have been if the government didn't rob them of that benefit by creating inflation.
Policy masks incentives that naturally benefit both producers and consumers. As Peter Schiff points out here, businessmen prefer falling costs to lower prices and boost volume. Yet inflationary mandates rob them of those gains. Artificial price stability distorts the free market, reducing purchasing power and hindering economic efficiency. Ignoring this dynamic misguides investors who assume policy neutrality. Next, Peter Schiff shows how understanding true market pricing can protect portfolios from unseen inflationary theft and structural distortions.
So I agree with Buffett that a 0% target is better than 2%, but I disagree that we need a target of 0. I disagree that stable prices are better than falling prices. Falling prices lead to higher living standards. And so I'd rather have that than stable living standards. And in fact, if you look at the amount of cash on the balance sheet of Berkshire Hathaway, it's an all-time record high. Now, I criticized Buffett in the past for not keeping his dry powder in gold. And I think maybe he would have preferred to keep it in gold, but I think he was very cognizant of the message that might have sent to the world, because the world really looks at the Berkshire portfolio. And had Buffett maintained a large gold position, that would have been a major vote of no confidence in the U.S. and the U.S. economy. And I don't think Buffett wanted to signal that loss of confidence, even if in his heart of hearts he believed it. And I think he probably understood that being in gold would have been better than being in U.S. Treasuries, but he took Treasuries anyway because I think he was afraid of what might happen if he loaded up on gold. But what he didn't want to do was load up on stocks, because he recognizes how overpriced the U.S. stock market is and how there are no real good values to be had given the valuations and given the economic problems that he clearly understands are in front of us.
Berkshire's cash hoard signals caution that mainstream media glosses over. As Peter Schiff points out here, Buffett avoided gold to prevent signaling no confidence in the US. Yet he recognized it as superior to treasuries in preserving value. Overpriced equities left him sidelined, highlighting structural market risk. Falling prices and higher living standards could reshape asset allocation if policy were more transparent.